This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, June 30, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 ETF, SPY, is sitting at $741, up 1.65%, staring directly at its 5-day high of $741.56. But look closer at the Nasdaq 100 ETF, QQQ. It surged 2.49% to $724.08, outpacing the broader market, while the Russell 2000 ETF, IWM, is quietly slipping to $298.97, below the $300 psychological barrier. We are seeing a classic bifurcation. Megacap AI growth pulling the index higher, while small caps and traditional value sectors bleed out. Today's pre-market action is defined by this narrow leadership and the fragility of the narrative driving it. Before we dive into the charts and flows, let's look at what is scheduled to move the needle. The most critical data point for the equity markets today is Nike, NKE, reporting earnings with an estimated earnings per share of $0.11. This is the first major test of consumer resilience for the month. If NKE misses, it directly contradicts the strength we're seeing in the consumer discretionary sector, the technology sector, and suggests that the current rally in the technology sector and consumer discretionary is speculative rather than fundamental. Also on the calendar is Constellation Brands, SDZ, with an earnings per share estimate of $3.28, which will offer another data point on consumer spending habits. For the broader macro backdrop, we are watching the 10-year and 2-year Treasury yield spread, currently at plus 0.28 percentage points, labeled as flat, which typically raises caution flags for growth-sensitive assets. Let's set the scene with the sector rotation. The technology sector, is up 2.37%, and consumer discretionary, is up 2.4%. These are the engines of the current rally. But the materials sector, is down 1.82%, and the energy sector, is down 0.48%. We are seeing a clear rotation out of cyclicals and into tech-driven growth, but it's a narrow path. The question is whether this leadership is sustainable given the underlying sentiment and technical structure. It's not sustainable, and here is why. The sentiment data shows a profound disconnect. QQQ is up 2.49%, but NVIDIA News Sentiment Score is stuck at neutral, plus 0.18 across 49 articles. That is a massive red flag. When the anchor of the tech rally is neutral while the index surges, it means the move is momentum-driven, not fundamental. Meanwhile, the VIX has compressed to 18.41, down 0.48 from the previous close. That low volatility environment masks the fact that hedging demand is evaporating. We are in a fragile bull profile where complacency is high, but the breadth is weak. Only 3 sectors are posting gains. If sentiment turns negative on NVDA during the open, the fade begins immediately.
I have to challenge that view, Pulse. You're assuming the QQQ surge is unsustainable based on NVDA neutral sentiment, but you're ignoring the technical reality of the breakout attempt. SPY is trading at $741, just 56 basis points below its June 29 high of $741.56. QQQ is at $724.08, challenging its own 5-day high of $726.83. This is a narrow lead dynamic. The technology sector is up 2.37% today, providing all the upward momentum. The technical setup is long biased but fragile. If SPY clears $741.56 with volume, we expose the 10-day range high of $756.68. If it fails, we revert to the June 29 open at $736.52. The structure is valid. The risk is purely in the lack of participation from the IWM, which is failing to hold $300.
Grid, you're treating a technical breakout as valid when the flow data suggests this is a liquidity trap. The IWM is at $298.97, down 0.29%, and it has failed to reclaim the June 26 high of $300.03. This is a severe liquidity drain in small caps. The rally is being carried by secondary narratives, not primary anchors. Look at Enphase Energy, ENPH, which is up 11.5% on the Open Compute Project news. That is a specific catalyst play, not a broad-based fundamental improvement. Meanwhile, DLR is down 4.7% on downbeat Q2 earnings. The market is rotating into speculative catalysts while ignoring the broader earnings reality. The breakout grid is talking about is technically shallow and lacks the breadth required for a sustainable trend.
I agree with CIPHER. The technical levels are irrelevant if the macro regime penalizes the multiples supporting this move. The 10-year 2-year spread is flat at plus 0.28 pp, labeled flat, caution. This contradicts the typical steepening required to support sustained equity valuations in a high-rate environment. You are mapping technical barriers at $741.56 and $726.83, but the flat curve indicates that the macro environment is not providing the liquidity or growth confidence necessary to sustain a breakout. Without a steepening curve, these technical highs are traps, not launchpads. The VIX at 18.41 suggests this pricing is fragile. Any CPI or PCE revision upward could trigger a rapid VIX spike.
Let's drill down into the specific assets driving this divergence. First, let's look at the Nasdaq 100 ETF, QQQ. It is at $724.08, up 2.49%, testing the $726.83 high. Grid, what does the chart tell us about this move?
The QQQ 10-day range is $702.81 to $745.45. Today's move is closing in on the upper bound. The critical structural support for this rally is the June 29 low of $705.17. However, the June 29 open of $713.99 is the first line of defense. If we reject at $726.83, we look to $713.99. The volume profile shows significant expansion, but it's concentrated in the top 10% of tickers. The breadth is not there to support a clean break.
And that's because the money is not flowing into the index broadly, it's flowing into specific names. NVDA sentiment is neutral. The money is in Meta, which has a positive sentiment score of 0.4, and Goog at 0.35. The rally is drifting towards secondary beneficiaries. This means the QQQ move is fragile. If Meta or Goog falter, the QQQ support levels become irrelevant because the underlying flow is gone.
Add to that the inflation pressure. CPI is 4.17% year-over-year, and core PCE is 3.41%. Both are significantly above the Fed's 2% target. This creates persistent hawkish pressure. The QQQ rally is a multiple expansion play. If bond yields move higher, or if the flat yield curve label shifts to inverted due to growth concerns, QQQ is the first to get crushed. The risk/reward for chasing QQQ highs is negative.
Now let's shift to the underperformer, the Russell 2000 ETF, IWM. It is at $298.97, down 0.29% and below the $300 level. Why is small cap struggling while large cap rallies?
Because the liquidity is draining out of the lower quartile. IWM is below $300 and has failed to reclaim the June 26 high of $300.03. The June 29 open at $298.11 is the next immediate support level before the June 29 low of $294.68. This is a breakdown confirmation. The IWM is not just lagging, it is actively rejecting rallies. The technical structure for IWM is bearish in the short term, with support levels being tested and failing.
This is a rotation signal. Institutional capital is rotating out of small caps into large cap tech. Look at the microcap volatility. UPC is up 311.49% and ZCMD is up 274.69% on massive volume spikes. This is speculative churn, unrelated to broad market health. It indicates that the money that is in risk assets is chasing noise, not fundamentals. The IWM is suffering Because the AI rally is not lifting all boats. It is a selective, narrow play. The lack of IWM participation confirms a dead cat bounce within the broader divergent structure.
And the sentiment on small caps is effectively non-existent. There are no bullish headlines driving IWM. The fear is concentrated in the defensive sectors. The healthcare sector, healthcare, is up 7.12% for the week, while the technology sector is down 3.51% for the week. Investors are hedging. They are buying healthcare and utilities as a hedge against the tech rally stalling. The IWM is the casualty of this risk-off behavior within the risk-on market.
Let's talk about the catalyst that could break this tension. ENPH Energy, ENPH. It is up 11.5%, driven by its entry into the Open Compute project. Is this a sustainable theme or a one-off play?
It is a specific catalyst play. ENPH is entering the Open Compute project as a platinum member, focusing on AI data center power standards. This is a crossover play between solar and tech infrastructure. It is not a broad-based sector rotation. It is a single-name event. The volume spike is real, but the sustainability depends on whether other solar or power management stocks follow. Currently, the energy sector is down 0.48%. So the energy sector is not broadly participating. This is an isolated strength.
Technically, ENPH is gapping up. The gap represents a new support zone. If the stock holds above the pre-market high, it could test the next resistance level. But given the narrow leadership in the market, this stock is vulnerable to a sharp reversal if the broader tech sector, the technology sector, shows weakness. It is a momentum trade, not a value hold.
Be careful with this narrative. AI data center power is a buzzword that can evaporate quickly. The underlying risk is that this is a buy the rumor, sell the news event. With the VIX at 18.41, any hint that this catalyst is overstated will trigger a rapid exit. The risk is high. Do not mistake a news-driven gap for a fundamental shift in the sector's value.
Finally, let's look at the consumer angle. Nike, NKE, is reporting today. The earnings per share estimate is $0.11. If NKE misses, what happens to the broader market structure?
A miss would expose the consumer discretionary strength as speculative. If Nike, a bellwether for consumer confidence, reports weakness, it contradicts the narrative of consumer resilience. The money would likely rotate out of the speculative tech rally and into the defensive strength of the healthcare sector. It would confirm the fragile bull profile that Pulse flagged earlier.
Exactly. The sentiment shift would be immediate. The buy the rumor trade on consumer discretionary would end. The neutral sentiment on NVDA would turn negative as the entire market reassesses the sustainability of the rally. A NKE miss is the trigger for the snapback.
Technically, if NKE misses, the SPY support at $736.52, June 29 open becomes the target. The QQQ support at $713.99 becomes the target. The current highs are distribution zones. A NKE miss confirms that the $741.56 level was a top, not a breakout.
Let's synthesize this. Grid flagged the technical resistance at SPY $741.56 and QQQ $726.83, but CIPHER showed that the flows are narrow, driven by ENPH and secondary names, not NVDA. Pulse highlighted the neutral NVDA sentiment and the low VIX of 18.41, indicating complacency. SPECTER pointed to the flat yield curve at plus 0.28 pp as a macro headwind. The consensus here is that the rally is structurally hollow. The SPY and QQQ highs are likely traps, unsupported by the flat curve and the lack of broad participation. The IWM breakdown confirms this. The market is bifurcated. The risk is on the downside if NKE misses or if NVDA sentiment turns negative.
To wrap up today's pre-market analysis, here are the key takeaways. First, the S&P 500 and NASDAQ 100 are testing key resistance levels at $741.56 and $726.83, but the technical breakout is questionable without broad participation. Second, the Russell 2000 is failing to hold $300, signaling a severe liquidity drain in small caps,
and a narrow, fragile leadership structure in large-cap tech. Third, the NVDA sentiment is neutral despite the QQQ surge, suggesting the rally is momentum-driven and vulnerable to a snapback. Finally, the flat yield curve and elevated inflation data create a macro environment that penalizes high-multiple growth stocks, making the current highs likely distribution zones rather than launchpads. What to watch tomorrow? The actual NKE earnings print and any follow-through in the NVDA sentiment score. If the sentiment turns negative, the fade begins. If the sentiment holds, the market may grind higher, but the structural risks remain. This is ShadowQuant Equities Edition. We'll see you at the open. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.